Welcome to Protect Your Assets Market Briefing. I'm your host, David Hollander, also known as the Sandman. Now let's get started. Quite a week in the market, starting off with the Fed meeting. The Dow went off this week, 2.9%. S&P 500 off 2.4%. NASDAQ off 2.2%. MSCI International Index off as well, 2.8%. And the 10-year Treasury off slightly to close at 4.21%. Oil was up this week, 3.3%, closing at $67 a barrel. And the sizable downshift in the job data indicated this week that the U.S. economy may be entering a softer growth patch. And this is due to the fact that there just is a softer labor market as we take a look at the numbers that were revised. You know, if we look back at the labor numbers, they've been pretty good overall, but they were revised recently. So April was the peak, according to the revision, at 158,000. Then all of a sudden, May, which came in at 139, dropped to 19. And June, which came in at 147, dropped to 14. So as labor slows down, this creates a challenge, more of a threat to the economy. And when you combine that with higher tariffs, the consumer may be more pressured to spend as things cost more and they lose their jobs or can't get a job. So this is what's going on right now in the market, and that's why we saw some pain this week. However, I still believe that the Fed is now more likely to cut interest rates, and this is reflected by the market still holding up fairly well. While growth may slow in the coming quarters, I do not see a recession on the horizon as we head towards 26, and we could see a rebound as interest rates move lower, possibly in September, and also as we see the tax bill start to kick in, because remember that those tax rules we covered last week from the Big Beautiful Bill. If you missed that, go check out the podcast. We covered that entire Big Beautiful Bill and things you need to know, particularly around taxes for 2025. There's some things happening right now that are the law that will be effective when it comes to filing your taxes. So I continue to recommend staying diversified and increasing your quality when the market pulls back like it is right now. Stay invested, but think about what you're doing. And that's because we've had a nice run in the financial markets overall. S&P's up over 20% since its April 8th lows. And we could still experience volatility as markets digest these higher tariffs and the softer job data. But use these bouts of volatility to rebalance your portfolio, and you should diversify across stocks and bonds and think about adding quality investments at a better price. Keep in mind that I also think that right now we're in the midst of the second quarter of earnings, and so far we've seen about 80% of companies report, and they've beaten their earnings expectations, and this means that corporate earnings growth remains on track to be positive for 2025. Now, what about this great question I got about the market this week? This came from Mark, and he reached out and he said, is the stock market in a bubble right now? And if so, what indicators or market signals should he keep monitoring or look at right now? And so I like the question, Mark. Thanks for asking it. Every bubble in modern market history has been based on a narrative. And that, if we look back most recently, was whether the internet was unlimited or the real estate market could just keep going higher. So if we give that narrative some credence, which is widely perceived by investors when you boil it down to be a source of unlimited earnings or unlimited growth across a certain market sector, well, today that bubble inflating theme is AI technology. And knowing what the narrative is, we can lean on hindsight and look back at prior bubbles to see where early warning signs could be found. So if an AI bubble does exist, what indicators could offer early warning signs prior to it popping? So Mark, looking back, 2006, 2007, we had a steady rise in mortgage delinquencies and property foreclosures. were one of many warning signs. As we look back further into 2000, the market peak, you may remember many retail trader.coms were popping up all over the place, and you saw a lot of retail, a lot of mom and pop investors, not institutional, get in the market, and they became a bigger source of the daily volume increasing. And we also saw a lot of borrowing going on with levels of margin trading happening. And these were warning signs that, as we saw, there was a burst of the dot-com bubble. This time around, you could focus on emerging, booming AI industry, and you could look at chip makers as the backbone of that industry. And of course, the big one that pops in mind is NVIDIA. NVIDIA could be viewed as a good proxy for the health of the AI trade right now. So if we were to look at NVIDIA specifically as our preferred proxy for the health of the AI trade, then the dream is alive and well, and stocks should be set to continue higher, as the stock just hit another all-time high on Thursday. Well, Mark, however, there are a lot of various factors that can impact a single stock. And in this case, you could draw a parallel with Tesla, as we call something cult following. It's where you get a lot of people just following a company because of what it is and who's leading it and what they're doing. And so instead of looking at a single stock, I would like to look at a much more prudent way to keep tabs on the broader based semiconductor index. So maybe the SOX, the SOX index, as it includes NVIDIA, could be another way to look at this. And in that index, there are other chip making people like AMD, Qualcomm, MU, AVGO, and MRVL. These are all like-minded, like industry type people in the industry. So for the idea of looking at the SOX as a better signal indicator, then this bull market in stocks, well, could have a problem. And the reason being that the SOX index hasn't hit new record highs since, get this, last July. You heard me right, July of 24, almost over a year ago today. So while the S&P 500 continues to power to record high after record high, the takeaway is, if the SOX isn't, well, what's going on? If AI remains the primary source of bullish optimism right now for a continued rally in the broader stock market in the months and quarters ahead, this market is in trouble, as the SOX should still be leading the market higher, not lagging considerably over the last 12 months. So to be clear, I'm not saying right now the rally's over, but if the SOX is, or AI is indeed acting as a leading indicator for the AI optimism right now, well, there could be a sense of complacency in the stock market right now, with risk, again, towards the downturn.
You can hear the Protect Your Assets market briefing on your favorite podcast app or as an Alexa flash briefing. Just search for Protect Your Assets market briefing. Links to subscribe free wherever you listen are at libertygroupllc.com/PYA briefing. The following program is paid for by Liberty Group, and the views and opinions of the host do not represent those of the station or its ownership. Investment advisory services are offered through Liberty Wealth Management, an SEC-registered investment advisor. Legal information provided on the air is not intended to be a substitute for callers hiring their own lawyers to advise them about personal legal matters. The information provided is general financial comment and cannot be relied upon for your specific financial situation. Investing involves risks, including the risk of loss of your investment. Please consult with a financial professional before investing. California Life Agent number 0B48569. You're listening to the Protect Your Assets Radio Network.